There's this comforting lie we tell ourselves whenever we pick up a new hobby,
Oh, yeah.
whether it's learning guitar or speaking French, even knitting. We tell ourselves it's a journey.
Mm-hmm.
You start out terrible, you make a few ugly scarves or screechy noises, and then slowly, over months or years, you get decent. It's a gentle slope.
Right. The classic learning curve.
Wow.
Struggle plus time equals mastery. We're sort of
Yeah,
conditioned to believe that as long as we don't quit, we're safe.
exactly. But today, we are taking that gentle slope idea and just uh, throwing it right out the window
Okay.
because we are diving into a world where that learning curve is, well, it's more like a cliff.
A cliff. I like that.
We're looking at the high-stakes world of Forex trading. And the source we have today, a guide by Hamid called The Disciplined Trader,
Mm.
Navigating the First 30 Days of Forex. It presents a reality that is, it's honestly pretty terrifying for a beginner.
It's a bit of a horror story, isn't it? At least for your bank account.
It really is.
Yeah.
Because according to Hamid, most beginner traders don't just lose a little money while they learn.
Oh.
They don't just pay a tuition fee to the market. They blow up. They wipe out their entire accounts. And the timeline he gives, it isn't a year. It's not even 6 months.
It's 30 days. The first 30 days.
30 days. That is an incredibly short shelf life. If I opened a lemonade stand, I'd have to try pretty hard to lose my entire investment in 4 weeks. I'd have to, literally set the stand on fire.
Right. So what's our mission today?
The mission is an autopsy.
An autopsy. Okay.
We aren't here to talk about how to get rich.
Yeah.
We're here to look at the corpse of that blown-up account and figure out exactly what killed it. Hamid identifies 5 specific mistakes. Lethal injections, really, that beginners give themselves.
We're going to see if we can find the antidote.
I like that. A forensic analysis of financial failure. But before we get to the mistakes, I have to ask about that timeline again. Why 30 days? Why does Forex chew people up so much faster than, say, buying stocks?
That's a great question, and it's something Hamid touches on, but we should make it really explicit. It's because of one word: leverage.
Leverage. Okay. Define that for the person who just thinks, I'm buying euros.
So when you buy a stock, usually you pay for the whole thing. If the stock drops 1%, you lose 1% of your money. It's slow.
Right.
In Forex, you're often trading with borrowed money. The broker lets you control huge amounts of currency with a tiny deposit, so a 1% move in the market could actually double your money, or it might wipe out 50% of your account instantly.
So it's like driving a Ferrari at 200 miles an hour when you've only just learned to drive a go-kart.
Exactly. The speed of the loss is it's amplified. And that leads us directly to the first, and honestly the most common mistake in the guide: over-risking.
Okay, let's unpack this. Because risk is a funny word. We hear no risk, no reward, right? We think entrepreneurs and traders are supposed to be risk takers. But Hamid says beginners take it way, way too far.
There's calculated risk, and then there's just gambling. Hamid points out that beginners often risk 5% to 10% of their entire account on a single trade.
Okay, can we just pause there?
Yeah.
Because I want to play devil's advocate for a second. Let's say I'm a new trader. I scrape together $1,000. If I risk 10%, that's $100.
$100.
That doesn't sound like a catastrophe. I spend that on a nice dinner. Why does Hamid treat this like a death sentence?
It feels harmless in isolation, right?
Yeah.
But you're ignoring the probability of streaks. In trading, losing streaks are inevitable. They're a mathematical certainty. Even the best traders in the world, hedge fund managers, algorithms, they'll have weeks where they lose 3, 4, 5 times in a row.
Okay, so if I'm risking 10% and I have a bad week.
Let's say you lose 3 times, just 3 bad calls. You're suddenly down 30% of your total capital. You have $700 left.
That stings, but 30% down. I feel like I could earn that back.
And that feeling right there, that feeling is the trap. This is what's called the math of recovery, and it is brutal.
Go on.
If you lose 30%, you don't just need a 30% gain to get back to even. You need about 43%.
Wait, really? Why?
Because you have a smaller pile of money to work with now, and it gets worse. If you lose 50% of your account, which happens very fast at 10% risk, you now have $500.
Right.
To get back to your original 1,000, you need to double your money. You need a 100% return just to break even.
Wow. Okay, when you put it that way, it sounds impossible. You dig a hole so deep in the first week that you have to perform a miracle just to see sunlight again.
And beginners don't perform miracles, they panic. Hamid's point is that by risking 5 to 10%, you put yourself in a position where one bad streak just ends your career.
So what's the alternative then? If 10% is suicide, what does the guide suggest?
The industry standard, and what Hamid insists on for survival, is risking 0.5% to 1% per trade.
1%.
1%.
Okay, hold on. I have to be the skeptical listener here again. If I have that same $1,000 account, you're telling me to risk $10.
$10.
That is incredibly boring. I mean, if I win, I make maybe 20 bucks. That's not financial freedom. That's barely lunch money. Why would anyone do that?
Because the goal of the first 30 days isn't to get rich. The goal is to survive to day 31. Think about it. If you risk 1% and you lose 5 times in a row, you're down 5%. You have $950 left. You're still in the game. You aren't panicking. You can still think clearly.
So you're buying time. You're paying a small fee to keep playing so you can actually learn the skill.
Precisely. If you risk 10%, you blow up before you learn anything.
Okay.
If you risk 1%, you survive the learning curve. But, and here's the kicker, even if you get the math right, even if you accept the boredom of the 1% rule, you can still ruin it with the second mistake.
Which is?
Overtrading.
Hamid describes this as reacting to every small price movement.
Right. It's constant action.
I have this image in my head of like the Wolf of Wall Street type, screaming at monitors, phones ringing. But for a beginner at home, what does overtrading actually look like?
It's usually quiet and it's deeply physical. You're staring at your phone. You see the line on the chart tick up. Your pulse quickens. You think, oh,
Yeah.
it's moving. I got to catch it. So you buy.
Okay.
Then 2 minutes later, it drops a tiny bit. You get that pit in your stomach. Oh no, it's crashing. So you sell.
It sounds like a slot machine.
It is exactly like a slot machine. You're chasing dopamine. The market is just, it's noisy. Prices wiggle up and down constantly for no real reason. The mistake beginners make is thinking every wiggle is a signal.
So they aren't analyzing anything. They're just reacting to flashing lights.
They're playing a high-stress reaction game, and Hamid notes the result isn't one giant explosion, it's death by 1,000 cuts. You lose the spread, you pay commission, you take a tiny loss, and you do it 20 times a day.
It sounds exhausting.
It burns you out. You cannot make good decisions if you're making 50 decisions an hour.
And this seems like it links directly to the third mistake. Because if I'm reacting to every little wiggle on the screen, it probably means I don't actually know what I'm looking for, right?
Spot on. Mistake number 3 is trading without a plan.
The Force uses a pretty blunt analogy here. Hamid says it's like driving blind.
It fits perfectly. Imagine getting into your car, putting on a blindfold, and just slamming on the gas. That's what entering a trade without a strategy is.
But wait, I have to ask, how do beginners decide when to press the button if they don't have a plan? They aren't just flipping a coin, are they?
Sometimes they might as well be. But usually, Hamid notes, they're relying on external noise. They're looking for a savior.
A savior?
Yeah, maybe they found a signal group on Telegram where some anonymous guy says, buy gold now, or they see a YouTuber say the euro's gonna crash.
Or the famous gut feeling.
Ah, yes, the gut. I just feel like the yen is oversold today.
I've definitely been guilty of that in other areas of life. I feel lucky.
We all have. But in a mathematical game like Forex, your feelings are? They're irrelevant. The market does not care about your gut. If you don't have a checklist, a literal written plan that says, I will only buy if A, B, and C happen, then you are just gambling. You're a tourist in a shark tank.
Okay, so we have the tourist who's driving blind, that's no plan. Driving in circles, that's overtrading, and driving at 200 miles an hour, which is over-risking. It's a guaranteed crash.
It is. But the crash itself isn't always the end. It's what happens immediately after the crash that usually wipes out the account for good. And this is mistake number 4. It's the most dangerous psychological state a trader can be in.
Revenge trading.
Just see, the name tells you everything.
Sounds like an action movie. But walk me through the psychology. I've just lost money. I was over-risking. I'm down 300 bucks. What happens in my brain?
Your ego takes the wheel.
Yeah.
You feel stupid. You feel angry. You feel like the market stole from you. And the immediate impulse, it's almost uncontrollable, is to win it back.
It's that I can fix this moment.
Exactly. I'm not a loser. I can fix this right now. So instead of walking away, instead of analyzing why you lost, you double down. You open a bigger trade. You throw the plan out the window entirely.
It's the double or nothing mentality. I've seen people do this at casinos. They lose a hand and they immediately shove more chips in angrily.
And the result is the same. Hamid says this almost always leads to bigger losses. Why? Because you're trading blind and angry. You aren't looking at the chart anymore. You're looking at your account balance and just willing it to go back up. You're trying to bully the market.
And the market is much, much bigger than you are.
The market will crush you without even noticing you were there. It turns a manageable loss, a business expense, into a total wipeout.
That's an interesting distinction, a business expense.
Think about a shopkeeper. If they have a slow Tuesday or they have to pay an electric bill, they don't scream and burn down the shop, they accept it as the cost of doing business. But revenge traders take every loss as a personal insult.
That is a huge mindset shift.
Mm-hmm.
But I want to zoom out for a second. We've talked about the mechanics, the risk, the lack of a plan, the ego. But where does this pressure come from? Why do beginners feel like they need to make massive returns right now? Why can't they just be cool with learning slowly?
And that brings us to the fifth and final mistake in Hamid's guide. And honestly, this is a modern plague. It didn't exist 20 years ago. Fake expectations from social media.
The source specifically calls out Instagram, TikTok, and YouTube.
It's the lifestyle trader myth. You know exactly the videos I'm talking about.
Oh, absolutely. The 20-year-old kid. He's usually renting a mansion in Dubai for the weekend.
Yes.
Maybe sitting on the hood of a Lamborghini.
Holding a stack of cash to his ear like a phone.
Right. And the caption is always something like, I made $5,000 in 10 minutes while drinking my latte. Ask me how.
It creates a poisonous baseline. It makes trading look like a video game with a cheat code. The beginner looks at that and thinks, well, if that guy can do it, surely I can double my account in a month. It frames Forex as easy money.
So when they actually start trading, and let's say they follow our advice, they risk 1% and they make $10.
They feel like failures. They compare their $10 profit to the Lamborghini guy's $5,000 profit. They think, this is too slow, I'm doing it wrong, so what do?
They up the risk.
They increase the risk to 10%, they start overtrading, they chase the hype.
So the social media lie is basically the fuel for all the other mistakes we just talked about.
It's the engine of destruction. It sets you up to fail because it sets an impossible standard. It's like trying to learn basketball, but you're only allowed to watch highlight reels of Michael Jordan dunking. You never see the missed shots. You never see the hours of boring practice.
Or the fact that the guy in the video might not even be trading.
That's the other dirty secret Hamid hints at. A lot of these gurus are making their money selling courses, not trading currencies. Or they're using demo accounts with fake money, but acting like it's real.
So we're comparing our real struggles to someone else's fake highlight reel.
Exactly.
Okay, so we have this perfect storm. We have risky behavior, no plan, emotional reactions like revenge, and it's all being driven by a fake reality we see on our phones. It's no wonder the source says people blow up in 30 days. It feels almost inevitable.
It is inevitable, unless you make a conscious pivot.
So let's pivot. Let's stop being the bearers of doom. Hamid's guide isn't just a list of ways to die. It's a survival manual. How do we move from being a gambler to an actual trader?
It starts with a definition. I really like how the source phrases this. Forex trading is not gambling if you trade with a proper plan, risk control, and mindset.
That word "if" is doing a lot of heavy lifting there.
It's the whole ball game. If you want to survive the first 30 days, you have to embrace the solutions Hamid lists. And honestly, they're boring.
Give them to me.
First, risk management. You have to accept the 0.5 to 1% rule. You have to look at a $10 profit and be okay with it.
You have to embrace the grind.
You have to realize that small numbers compound. If you survive, you can grow. If you blow up, game over. Second is discipline. That means following your plan strictly. If your plan says no trade today because the market is messy, you don't trade, even if you feel lucky.
It's about being your own boss, right?
Yeah.
You have to be the strict manager of your own internal employee.
Exactly. You have to fire the gambler inside you. And this requires the third pillar, patience. Hamid warns, don't expect instant results. You have to detach from the timeline. If it takes 6 months to become profitable, it takes 6 months. If you try to force it into 30 days because you have rent to pay, you will lose.
That's a really important point. Never trade with money you need for rent.
Never. Because that pressure leads to bad decisions. And the final pillar is consistency. Focusing on the long term, not the individual trade.
This seems like the hardest one for beginners. We're wired to judge success by what happened today.
Right. Did I make money today? Then I'm smart. Did I lose money today? Then I'm stupid. A professional doesn't think like that. A professional asks, did I follow my plan today?
So you could lose money on a Tuesday, but if you followed your plan, that's actually a successful day.
Yes, because the outcome of one single trade is statistically irrelevant. It's a coin flip. What matters is the outcome of the next 100 trades. That's the law of large numbers. If your edge is good, the math will work out over time. But you have to survive long enough for the math to work.
The source sums it up with a mantra: learn, practice, stay disciplined, trade smart. It's interesting, the order there. Learn is first, trade is last.
Most people flip that. They trade first, lose money, panic, and then try to learn how to fix it, Hamid is saying. Reverse the order.
Looking back at all this, the first 30 days guide is almost like a test of character rather than a test of intellect. It's not about being smart enough to predict the global economy. It's about being disciplined enough to not sabotage yourself.
The market is a mirror. If you are greedy, it shows you. If you are impatient, it punishes you. If you are undisciplined, it takes your money. The first 30 days are about mastering yourself, not mastering the charts.
So if you're listening to this and you're thinking about dipping your toes into Forex, or maybe you're already in that first month and feeling the heat, just take a step back. Look at your trade size. Are you risking 10%? Are you trying to get revenge on the market because you had a bad morning?
Ask yourself if you are driving blind. Because if you are, the crash isn't a possibility, it's a certainty.
And maybe unfollow a few of those Lamborghini traders on Instagram.
That might be the best risk management tip of all.
So here's a final thought for you to chew on as you go about your day. We talk a lot about how boring real trading is, 1% risk, waiting for the right setup, not chasing the excitement. If social media has trained us to crave constant dopamine and fast results, is the boredom of slow, consistent growth actually the only true sign that you're doing it right?
That is the golden question.
Ask yourself, are you looking for a career which is often repetitive, boring, and requires patience? Or are you looking for a casino, but you just want to call it investing so you feel better about it?
Because the market is happy to be a casino if that's how you treat it, but the house always wins in the end.
Thanks for listening to The Deep Dive. Keep your risk low, keep your discipline high, and we'll see you next time.
Trade smart, everyone.